I've been learning about proportional and non-proportional reinsurance, but I'm still unclear about the key differences. Can you explain these terms and provide some examples?
Of course. Let's start with proportional reinsurance. In this type, the insurer and the reinsurer share both premiums and losses in an agreed ratio. For instance, in a 50-50 quota share agreement, the reinsurer covers 50% of the risk, receives 50% of the premium, and pays 50% of any claims.
So, both the risks and rewards are shared equally based on that ratio?
Exactly. Proportional reinsurance is all about sharing. Another example is surplus share reinsurance. In this case, the insurer keeps risks up to a certain limit, and any excess is passed to the reinsurer. For instance, if an insurer can retain $1 million in risk and a policy is for $3 million, the remaining $2 million is transferred to the reinsurer.
That's helpful. So, proportional reinsurance splits both premiums and claims in a fixed way. How does non-proportional reinsurance differ?
Non-proportional reinsurance works differently. Here, the reinsurer only steps in after the insurer's losses exceed a certain amount, called the retention limit. This is commonly referred to as excess of loss reinsurance.
Could you provide an example?
Sure. Let's say an insurer has a $5 million retention limit. If a claim is $7 million, the insurer pays the first $5 million, and the reinsurer covers the remaining $2 million. So, the reinsurer is only responsible for losses above the retention limit.
So, in non-proportional reinsurance, the reinsurer steps in as a backup after a certain threshold?
That's right. Non-proportional reinsurance is typically used for catastrophic events or large, unpredictable claims. The insurer handles regular, smaller claims, while the reinsurer takes on the larger, less frequent ones.
It sounds like proportional reinsurance is good for managing regular risks, while non-proportional is more about protecting against rare, large losses.
Exactly. Proportional reinsurance suits portfolios where risks are predictable and need to be shared, while non-proportional reinsurance limits exposure to significant, unexpected losses that could threaten financial stability.
Do insurers typically use both forms?
Yes, they often do. Proportional reinsurance helps with consistent risks, while non-proportional reinsurance provides protection against large-scale events. Together, they balance the insurer's portfolio effectively.
That's really clear now. Proportional reinsurance shares premiums and claims from the start, while non-proportional reinsurance covers losses only after they exceed a set threshold.
Exactly. Both types are crucial, and understanding when to use each helps insurers manage risks at all levels. As you advance in your career, you'll see how both fit into broader risk management strategies.